Today, we will talk about last in, first out, or LIFO. Last in, first out, or LIFO, is a method used to account for business inventory. It records the most recently produced items as the ones that are sold first. This means that the cost of the most recent products purchased or produced is the first to be expensed as cost of goods sold, while the cost of older products is reported as inventory. There are two alternative methods of inventory costing: first in, first out, FIFO, and the average cost method. LIFO is only used in the United States under generally accepted accounting principles. The International Financial Reporting Standards, IFRS, used in most countries do not allow the use of the LIFO method. Businesses that use LIFO valuations need to maintain large inventories, such as retailers and auto dealerships. This method allows them to take advantage of lower taxable income and higher cash flow when their expenses are rising. When there is high inflation, the choice of accounting method can dramatically affect valuation ratios. FIFO, LIFO, and average cost have different impacts. In periods of deflation, LIFO creates lower costs and increases net income, which also increases taxable income. For example, if a company has 10 widgets, and the first 5 cost $100 each, while the last 5 cost $200 each, the LIFO method would mean the last widgets in are the first ones to be sold. This results in higher costs and lowers net income in times of inflation, and the opposite in periods of deflation. The choice between LIFO and FIFO depends on the business you're in and whether you run a public company. LIFO decreases net income on paper, which reduces the taxes you owe, assuming inflation is at work. For public companies, this may not impress shareholders. Here are 4 key takeaways. 1. Last in, first out, LIFO, is a method used to account for inventory. 2. Under LIFO, the costs of the most recent products purchased, or produced, are the first to be expensed. 3. LIFO is used only in the United States and is permitted under generally accepted accounting principles, GAAP. 4. LIFO accounting can minimize taxable income during years in which inflation is driving up the costs of doing business. Hope this would help. Thanks for watching.